All graphs contained herein are shown for illustrative purposes only. There is no guarantee that any investment strategy will achieve its objectives, generate profits, or avoid losses. Past performance is not indicative of future results. Any issuers or as mentioned are examples only and are not investment advice. Index returns may be referenced, although you cannot directly invest in an index.
Hello and welcome to the Upside Catcher podcast. I'm your host, David Stubbs, Chief Investment Strategist at AlphaCore Wealth Advisory, an RIA based in San Diego. Today I'm joined by Stephanie Roth, who's Chief Economist at Wolfe Research, a leading independent research shop. We're going to be talking about the impact of the Iran war on the US economy. We'll touch base on private credit, where are we at right now, and I can't wait to get Stephanie's thoughts on artificial intelligence, both the upside on productivity and impacts on the labor market as well. Now, before we begin, please remember, folks, that nothing on this podcast is investment, tax, or legal advice. Stephanie or I may have positions in securities or assets that we discuss, and always do your own research. Now, without further ado, Stephanie, welcome to Upside Catcher.
Thank you for having me.
Great. Look, we've got to start with the Iran war. It's dominating everything, dominating the headlines, dominating the news, dominating the markets. I know that you and your team have done some detailed work on the impacts on inflation, and then we'll go from there into the economy. So first, tell us, how big an energy shock is this, and what are the implications for prices in the United States?
Yeah, so the way we look at it is somewhat similar to 2022, only in terms of the amount and the extent of the shock. So as you'll see on this slide here, Brent in that time period rose by about $25 and stayed there for about 6 months. This could be a similar analog in terms of today you might see that type of price increase sustained over a period of time and then similarly fade after a number of months, in which case for every quarter it stays like that, the estimated impact on real GDP is somewhere between 10 and 20 basis points, and the impact on headline inflation is about 40 basis points. So I think today is kind of a similar trajectory. The thing that's very different, though, is the Fed's reaction function, because the economy today is really different. So the amount of the shock itself might be similar, but the reaction function and how this sort of flows through to what the Fed does is probably quite a bit different.
Now, let's dig into that. Obviously, when we had the last energy shock, and it does seem that hits keep coming, right? We had huge volatility with energy around COVID. Then, of course, the rebound where we had a lot of inflation around the world, partly reopening, partly stimulus. And then we get hit with Russia, Ukraine, huge energy shock. Then you mentioned the reaction function. So talk us through that. First, your reaction function, what is it? Of course, it's how central bankers will react to a certain set of data relative to their desire to hit their goals, usually low and stable inflation, full employment when it comes to the Fed. Talk to us about what they did then and what they did now, and the differences and how markets might react.
Yeah, sure. So yeah, this is really all about how is the Fed going to react to the shock that is at play. And generally speaking, in the textbook scenario for an energy price shock is for the Fed to look through it and to kind of wait and see how things play out, and then ultimately sort of adjust policy if it's needed in line with their dual mandate, the employment and inflation. But what was kind of different about 2022 is that it was an energy shock on top of an environment where there was also a shock to demand, a strong shock, meaning demand was incredibly positive, in part tied to the economy finally reopening after COVID. There was a ton of fiscal stimulus. So that led to the economy being a lot stronger than certainly it is today. So what you'll see on this slide here is that inflation back in 2022, at the time of the energy shock, was running at 5%, and this is core inflation. Today, it's running around 3%. Unemployment at the time was running at about 3.7%, and it was dropping to 3.5%. Today, it's 4.3%, 4.4%. And payrolls back then was running at 600,000, and today it's kind of in the 50 to 70,000 range. So the fundamentals of the economy are really different. And what's the sort of comparison is back then the Fed was ultimately hiking, and partially in response to the energy shock, but also it was just an economy that started to show signs of overheating. Today, it's unlikely to do that for a lot of the reasons that I just mentioned. So the Fed is likely to be able to just wait and see how things play out before they ultimately adjust policy. And we certainly don't think they're adjusting policy higher. We think eventually they'll be able to cut rates again, but probably not for a little while.
Yeah, I think the other couple of things that are different here is, of course, the excess savings that we all spent ages talking about, trying to model, et cetera, which of course is a function of the stimulus from the federal government. That's gone. Probably a good thing. That's an adjustment. We had obviously the Fed's balance sheet share of GDP much larger, as well. So I think your point is well made. There's a lot of momentum, a lot of different things happening here. You mentioned the labor market there. You've got the payrolls number, earnings growth, presumably much faster back then as well, given the tightness of the labor market. I mean, how is this going to balance out the other things that are going on? I think a lot of people came into the year with a positive view based on AI investment and also because of the fiscal situation, right? You've got obviously the big bills passed under the Biden administration still having some effect. And of course, the mammoth bill, the one big beautiful bill passed by the Trump administration last year. How's this all going to balance out? Is the economy still on a reasonable footing given the energy shock?
Yeah, so one way that we looked at this was the amount of the One Big Beautiful Bill stimulus for the consumer, because that's kind of the more important piece of the bill when it comes to sort of the economy and the flow through from fiscal, compared to the cost associated with higher gasoline prices. And then we also included some of the other categories like airfares and other energy prices to sort of estimate the balance between the two. And that's what you'll see here. Here we assume that a 20% shock is sustained throughout the course of this year, on average, and that we flow that through to some of the other categories, airfares and energy, and then compare that to the amount of the tax cuts that are going to come to consumers. And what you'll see is that for most of the income buckets, they are net benefiting still, even though there is this energy shock, at least for the middle to upper income cohorts. The lower income groups are going to still be suffering because they are still forced to pay higher gasoline prices. Gasoline prices are a higher share of their after-tax income than other people, and they don't really get the benefits from One Big Beautiful Bill. So net, the economy still should be better off. Our expectation is the consumer is still pretty solid this year. You're starting to see credit card data, specifically for the month of March, still look quite solid, and we expect that to sort of continue into April as more tax refunds hit. Tax refunds are up about 14% year over year, which is just a little bit shy of what we had been anticipating, but still a pretty solid increase. And that's largely tied to the stimulus bill, which will ultimately be spent by consumers in our view.
Yeah, interesting. I think that the front page of your presentation talks about all the different letters associated with the economy, the K-shaped economy, something we've talked about in our outlook, something I think that a lot of people are focused on where, upper, quintiles of income earners who are maybe asset rich have been doing very well the last few years, others struggling. It seems to me this is going to worsen that. I mean, you look at these charts. Yeah, the hit for gasoline is so much focused on the lower end, and of course, the One Big Beautiful Bill a little bit more beneficial to the middle of the upper class. I guess is that the conclusion you draw, that the K-shaped economy is just going to continue to widen?
Yeah, I think that's fair, at least in the near term, especially, as gasoline prices are remaining particularly elevated given the war is still ongoing. If you do have an economy that improves a bit, then at least the bottom of the K may see some marginal benefit just because the economy is getting a little bit better and they tend to be more sensitive to the sort of the swings within the economy. So the base case is that for now it does worsen the K-shaped part of the economy. Those that are sort of very much low income are going to be struggling even more than they've been for the past couple of years. That may not last forever because, we do think that gasoline prices will come down a little bit from where they are today. And if the economy does pick up, then those people can do a little bit better. But temporarily, yes, it does make the K-shaped economy a bit worse.
I want to come back to you near the end when we've talked about productivity and labor market, et cetera, and get a view about where we might be specifically with the Fed, there. But for now, let's pivot to private credit. This has been a huge topic, of course, in the industry. Here at AlphaCore, we specialize in placing private markets and alternatives at the heart of portfolios. We've been long-time investors in private credit. We've been engaging with our GPs very intensively on this. How do you see the outlook for the asset class right now, and how do you read the behavior we're seeing of both investors and some of the GPs around withdrawals?
Yeah, and I mean, it's been sold to investors, particularly on the retail side, with the understanding that it is not a particularly liquid asset, and there may be redemption limits. At various points, generally about a 5% redemption limit. In fact, in the most recent quarter, it's actually drifted above that 5% limit, as some funds wanted to add a little bit more liquidity. So that is the nature of the asset class, and perhaps wasn't necessarily sold to some of those people with the full understanding or the appreciation that they're investing for the sort of medium term. Our base case is that it probably won't create a tremendous issue. Of course, there are risks. There is a lot of exposure to software. Software is, of course, one area of the economy that is potentially going to get disrupted by AI. But I think it's also interesting to flag a couple of things that make the outlook look a little bit better. One, the maturity wall can continue to kind of get pushed out. So if you look at the chart on the bottom here, the maturity wall before sort of updating this chart, it looked a lot more front-loaded. Now it's gotten pushed back a little bit. That could continue, similar to commercial real estate a couple of years ago, where there was this sort of extend and pretend where the maturity wall just continued to get pushed out. That may be the case again as well. And a reason is there is a very tight connection between private equity and private credit that perhaps doesn't get the full appreciation today. And what I mean by that is a very large share, roughly 70% of those who are getting direct lending are owned by private equity companies. So because they're private equity owned, and then private equity often has, especially the bigger ones, have their own private credit arms, there is this circular dynamic here. And while that could sound risky, and there are inherent risks in that, that also helps to keep the wheels moving, because everybody's incentivized to allow credit to continue and to continue to flow. So while there might be an issue in the next recession, maybe there is a tightening of credit tied to private credit, I think it's fairly unlikely that private credit in and of itself will cause a significant economic disruption. And most likely this will just sort of continue to be something that the market is worried about, but ultimately never pans into a big problem.
Yeah, I think you've got it on your next page, the sponsor-backed share of deals there, and it is very high. That in the top right-hand corner there. Certainly, that was my experience working at Blackstone. You're the same companies, a big private equity arm, big private credit arm. The two aren't supposed to talk, but there's that interaction between the big players on both sides. I think forces people to be invested in the future of the system, to have tough conversations, potentially to put up some equity for deals that are struggling. And I think that you're right. This will ultimately is not nearly large enough to cause a major issue in the broader economy. I do think it's probably, as you say, maybe the end of the third inning for private credit. We've seen this big explosion of activity. As it matures, you're going to have some players that leave the space. You're going to have potentially some alteration in pricing. I've always seen it as a healthy competitor to the banking system and the bond market, kind of the third leg of the stool. You've got the chart on the bottom here about the commitments from the banks to private credit. I mean, how do you see the impact on broader financials? Is the exposure enough to be concerning, or is it actually an opportunity where the banks and the bond market can retake some of the market share that they've lost to private credit in recent years?
Yeah, I think it's more of the latter. I mean, the actual numbers are not that large. We're talking about around $100 billion for commitments from U.S. banks. It's really not particularly big. Of course, the direction of travel has been significantly higher. The one risk is that should there be some challenges in private credit, say in the next recession, maybe that causes a tightening in financial conditions also from the banks, because now they do have some exposure. But I don't think it's really all that large to matter. And to your point, maybe that increases, a bit of competitiveness for that perspective. But generally speaking, I don't. This exposure doesn't seem to be particularly large. Of course, maybe there's more hidden exposure than than is obvious on the paper here, and that we may only find out if and when there is an issue. But on the surface, it doesn't appear to be all that concerning.
Yeah, I would agree. I mean, you and I worked together at JP Morgan once upon a time. And of course, when Jamie Dimon comes out and says that he's reducing his exposure to private credit, it's headline news. But I think that is a perfectly reasonable and fairly modest kind of reaction to, again, the maturing of the industry, some of the questions over some of maybe the new players. And I think that this is going to be an ecosystem that ultimately is a great win for the private sector, where innovators and people looking to raise capital have multiple places to go. We saw it in 2023 when the banks were weak after the regional banking crisis. Private credit stepped in, facilitated numerous IPOs and leveraged buyouts there that simply wouldn't have occurred if the banks had been the only game in town. So I think this is a really important evolution, but worth watching. And definitely, you hit on a great point: is that anyone investing in private credit needs to understand the liquidity provisions. Occasionally, there are going to be prorations where clients can't remove all their money immediately. That's a feature, not a bug. And I think as long as people understand where it is positioned in the liquidity spectrum, private credit is, I think, a very useful asset class going forward. What do you think about that?
Yeah, I think that's right. And you're getting paid for that illiquidity premium. And that's why it's one reason why yields are so much higher for investors in the space, because they're giving up that liquidity. And that's, to your point, it's a feature, not a bug. But there has to be that understanding that even if maybe you're either a little bit concerned about the space or you want to free up money elsewhere, it's probably not going to come from your investments in private credit. It's going to have to probably come from elsewhere.
Totally, totally. Now, look, on the next page, we're going to talk about maybe the issue, right? As Paul Krugman once said, productivity growth isn't everything, but over the long run, it's almost everything. Because without productivity growth, it's very hard to improve living standards. And alongside that, if businesses are looking to keep profit margins high, grow earnings, it's absolutely essential. Now, I think most people believe that we're on the cusp of a major productivity surge here, that AI is a very significant general purpose technology. And the implications of that, are pretty profound. So I know you've done a lot of work on this over the last few years. I've been lucky enough to read some of your writings. Talk us through about where you think we're at with productivity. Is the surge arrived? Is it going to be similar to the late 90s, early 2000s wave, longer, smaller? How do you see it?
Yeah, I mean, it may very well be something equivalent to that. No, we're not necessarily there yet. And the productivity gains that we've seen recently, because productivity has been fairly firm, is probably not a function of AI so much, at least for broad industry. So what you'll see on the slide on the right is AI adoption by industry, and then the annualized change, or 5-year annualized change in productivity. The reason we use 5 years is because productivity data are very volatile. And tech and professional services, a little bit of finance, those industries you do see a bit of a correlation, because they do have higher adoption rates, and that probably helps explain some of their productivity. But for the other industries, it's probably not the explanatory reason as to kind of what's going on within productivity. So we are very much set up for the potential to see some sort of 1990s style productivity boom. Probably not in 26, maybe 27, 28, could be a couple of years away. But the technology is very productivity enhancing. And one piece of that, though, is, I guess it's twofold. One, you tend not to have strong productivity cycles and inflation problems at the same time. So the market was onto something before the war in Iran broke out, because the focus of the market at the time was disinflation and how low can the Fed ultimately cut, partially because AI is disinflationary. And the reason is because you could produce a lot more and have lower input costs because you don't have to pay people quite as much. So your costs are reduced and your output is increased. And AI is, the key example of something like that. So realistically, you'll probably have a disinflationary cycle whenever AI really takes off in a material way, when businesses are truly adopting it. And then at the same time, you are unlikely to see too much disruption in the labor market. Now, there might be periods of time where the unemployment rate rises temporarily, but realistically, you're likely to create a lot of jobs that's associated with AI. In fact, we've estimated that about 700,000 jobs have been lost, probably tied to AI in the past 2 years. Yet the economy has added about 1 million jobs because of AI. A lot of them have been construction related, so it's not as if it's an easy handoff from the jobs that are lost, which were largely in technology and professional services. And the jobs that have been gained are partially because of construction, and then partially sort of assorted AI-related jobs across various industries. But I think that just is a reminder that there will be jobs created. It's easier to focus on the disruption and the jobs that might be lost, but there's likely a tremendous opportunity for new jobs to get created. And in fact, on the chart here on the left, this is one of my favorite charts. It shows that since 1940, about 60% of people are employed in occupations that didn't exist back then. It's just a reminder that the labor market's going to be changing a lot. Some jobs will turn over, some jobs will get eliminated, and new jobs will get created, but it's hard to envision what those jobs are because we don't know exactly what the future is going to look like.
Yeah, I think very well made that point. I think it's tempting to look back and see some of these technological shifts and say, well, we destroyed some jobs here and we created some jobs there. I think the big question is just the friction of that process. As you said, professional white collar worker loses job, construction industry is hiring. That's a hard shift. Over time, I think that shift gets easier as technology moves throughout the economy. It's not so focused on, say, the build out, which we'll talk about in a moment. But overall, it's simply a case of shifting to a different set of employment drivers. And that chart on the left is a killer chart because, in 20, 30 years from now, who the hell knows what jobs are going to be dominant, and you'll be able to put together a chart like that and see a whole new set of industries that have cropped up, partly because of the AI boom, partly because of innovation elsewhere. I think you have, if you go down 2 pages, some more facts and figures about the AI, productivity build out and the capex there. Is this still, the trend in the economy that's going to be driving parts of the overall economy and be such a powerful earnings driver as it was really the last 18 months or so in US large cap equities?
Yeah, I mean, it might be a more moderate driver than where it's been because it's been growing so robustly that it probably can't continue at that pace. But it drove, by our estimates, it boosted GDP by about 50 basis points last year. We expect around the same this year. So the earnings, the earnings trajectory is, potentially similarly strong. Of course, the multiples took a hit for a lot of names, just because of the uncertainty and the sort of the negative rhetoric that had come out most recently. But we estimate that AI-related CapEx represents about 2% of GDP. So it's the size of the sort of the AI sphere. And to put that into perspective, housing currently represents about 3.5% of GDP. And during or at least ahead of the financial crisis, it represented about 6.5%. So the 2% of GDP tied to AI isn't really all that large when you think about it, or at least it certainly doesn't appear frothy or bubble-like, at least at this point. Eventually, if you continue to grow at this pace, then yes, you probably will ultimately land into an AI-related bubble. But we're probably not there yet. It's not all that large. It's still earlier in the innings, such that companies are still trying to figure out exactly how to use it and exactly what AI CapEx needs to be done. Eventually, companies will probably invest too much, and then it will become an issue. But generally speaking, when you had big investment booms that turned into a bust, you were typically in the 3 to 6% range of GDP, and we're not really quite there yet.
Yeah, totally. I continue to look at the tightness of the data center market, and it's still extremely tight. These huge announcements, especially last year, of huge gigawatt new data centers. Those are not going to be turned on until 2029, 2030, 2031. So I think that at AlphaCore, we've talked about the possibility of there being an oversupply in the data center market at some point in the early 2030s. That's a long way from now. And for all we know, the growth of AI compute will actually continue to push that out. But I totally agree. We're not in bubble territory yet in terms of the investment. We maybe are in winner take most territory, and I think that the market has shown to be pretty brutal if companies have been investing a lot, but their models are not deemed cutting edge, not deemed market leading. And I think we've seen that on the other side. If you believe, if you're able to prove that your model has really made huge strides and has new capabilities, you're well supported. I think Alphabet, the Google parent company, went up by something like 60% last year because of their success there. I mean, there is this element of circularity in the flow, though, Steph, right? every day you seem to see another investment by one large AI company into another one. Sometimes it's a competitor, sometimes it's a supplier, sometimes it's where you get your chips from. So it seems to be pretty complicated. I guess in some ways it's to be understood and understandable, because this is a rapidly changing environment. You want to support the broader ecosystem. There's huge cash flow being generated, so you've got to do something with it. So why not invest in other parts of the fast-growing ecosystem? But other people are pretty nervous about it. How do you see it? Like, understandable part of the environment, or kind of big red flag?
I think similar to how we just talked about private credit, that this is a feature, not a bug, of a really fast and rapidly growing part of the economy, that this allows growth to continue to expand at such a rapid pace, because companies are both the customer and the client all at the same time, or customer and the provider all at the same time, which, it creates some inherent vulnerabilities to some extent, because if part of the chain gets severed, then perhaps that there are in a negative feedback loop. But I think at the moment, it just allows much faster growth, because these companies can help the others to grow more rapidly. So I think it is something to keep an eye out for. Certainly creates some additional risk, but also helps to sort of create an environment that is so rapidly growing. So I would view it as more positive than negative, although, of course, it's something to keep a close eye on.
And of course, in this chart you've got a few names which are still in the private space and are potentially big IPO candidates going forward. And I think that if we do see this entire lineup being public, we'll then be able to see the market render judgment on who is actually going to generate sustainable earning streams, who maybe has an over reliance on someone else. The correlations between the names will be very, very interesting. So I think that is where we're going to see the market be able to render a judgment when you get some of these into the public space. Just briefly on that, do you have any thoughts on these mega IPOs that we might see? Is it a case that there's a finite amount of money out there, and like these are going to suck away capital from everything else, or is it just a sign of renewed buoyancy in the capital markets?
I think probably more the latter. Probably more renewed buoyancy in the capital markets. I don't think it's necessarily going to sort of suck capital from elsewhere. Capital will flow where it deems to be the best fit. Um, and by the way, capital has been removed from the AI related space sort of somewhat recently, so that capital could easily come back in. You could easily see a shift back in the market towards the tech and AI space, and I think you probably will at some point. I mean, the shift has been fairly dramatic and surprising for many, and perhaps not warranted in my view. I think that this is transformative change and going to become a really key part of the productivity cycle in the economy for the next decade, in which case multiples at some point will probably expand again.
One final topic. You've always been very focused on the housing market there. You mentioned it previously. You've got a slide a couple of pages up in your deck there. And I think this issue of housing affordability is so interesting on so many levels. I mean, economically, we see very few housing transactions. There's this standoff because of the affordability issues that you point to in the chart here. Politically, this has become a central part of the debate, the affordability debate. It's not only about housing, but there's obviously energy, which is now going to be under pressure. There's also food inflation as well, and this has become a talking point on both sides of the aisle. The Trump administration has pulled several levers to try to bring mortgage rates lower. They look like they're having some success. There with the 10-year drifting lower and the spread declining. There was just before the Iran war, I think, a moment where 30-year mortgages dipped under 6%. That got some headlines there. Uh, how do you see the market reacting and faring if mortgage rates don't come down? How long can we stay in this kind of standoff, this low transaction standoff, and what are the macroeconomic implications of that?
Yeah, I mean, we're in an environment where housing affordability is really challenged, and there's not that much that can be done. To your point, the administration has had some limited success in terms of pushing mortgage rates down a little bit, although the war in Iran has pushed them in the opposite direction. Could we stay at like this for a while? Yeah, we probably could, because what eventually will happen is people will continue to just need to buy a house because of family needs or they need to move. And eventually, because with the huge issue here is that the average effective mortgage rate, the mortgage rate people are actually paying versus the mortgage rate that they would pay on a new house, there's a very wide gap there. But as the economy adjusts and time passes, those two will come together, in which case people will feel better about the mortgage rate. Now, can they afford it? That's a challenge. Realistically, the economy will have to grow in to this level of housing prices. So what you'll probably have happen is maybe mortgage rates come down a little bit, and the economy grows with incomes rising fairly strongly, and then eventually people can afford houses a little bit more. Because the only other way to really improve affordability is either mortgage rates come down a lot or house prices fall. And house prices don't generally fall in an economy that's healthy. So that's kind of unlikely to sort of solve the affordability problem at this point. Realistically, it's going to have to be mortgage rates coming down. And I do think that they will once the war in Iran ends. Realistically, mortgage rates will probably come back down, in which case now you're in a better position. Similar to where we were a couple of months ago when you started to see signs that housing activity was picking up. So it's fair to be optimistic on the housing market, say in the back half of this year, because best guess is that rates come down a bit and then you see activity resume. Maybe not so robustly, but better than where it's been.
And of course, the other distinction there or difference is not, as you said, there's one between existing mortgage levels and new mortgage levels in terms of interest rates. But there's also a huge gap now between the cost to own versus the cost to rent. The cost to own is sky high, right? You have the house prices high, mortgage rates are high. There's obviously the cost of ownership that you take on, be it property taxes, for example, maintenance, and maybe it's not when you're a renter. I think the unfortunate conclusion, if your scenario plays out, is that that gap closes not with house prices coming down, or maybe a little bit it comes with mortgage rates coming down, but rents could grow significantly in the back half of this decade. And I just wonder, Steph, if people are annoyed about affordability today, where are we going to be in 2030 when rents have surged to make up that gap?
Yeah, I mean, that in a vacuum, that sounds like a really bad scenario. However, if this AI story plays out like we talked about, you might be in an environment where real incomes are rising fairly substantially, and perhaps that helps to bridge some of the gap. Of course, housing itself will be elevated, but people might feel better about the affordability story in that backdrop where their real incomes have been, rising for several years, which has not been the case over the past couple of years, which is why people feel so bad. And maybe I'll turn back to one of our slides that we had earlier on affordability. And the only positive story that the administration had to tell about affordability was gas prices. This was updated before the war started, and gas prices was the only thing that hadn't risen significantly since before 2019. Everything else, especially mortgage payments, car payments, all of those things have outpaced wage growth. But if you're in an environment where wage growth outpaces the rest of those things, then your real wages are positive, so your inflation-adjusted wages are good, and then you might feel a little bit less strapped when it comes to your housing costs because not everything all at the same time feels so elevated.
Yeah, I think you're right there. And this is going to be a huge challenge and a huge political issue. I mean, again, this is since 2019. We've cycled through three different presidential terms. There's an argument that the higher inflation environment is somewhat structurable. Deglobalization, tighter labor markets, etc. Very interesting to see if we do manage to get a grip on some of these key parts of the affordability complex. Steph, I want to leave you with one final question. Just give us an overview then about the next 12 to 18 months of US macro. From what I'm hearing from you is, let's assume the Iran war does end sooner rather than later. Once we get past this, inflation subsides, mortgage rates and interest rates subside, and eventually the Fed cuts interest rates. Is that your central scenario right now?
Yeah, the central scenario is you're right. The war ends sooner rather than later. We're in an environment where spending is pretty decent. You have a tailwind from AI still playing out in the economy. a little bit of a boost from One Big Beautiful Bill on the investment side from a corporate perspective. Inflation starts coming down in the back part of this year, but only modestly. And you have a Fed that leans a little bit more dovish, only modestly so, with the new chair. So Kevin Warsh, while he can't convince the committee to cut rates if the economic data don't support it, he could set a slightly more dovish tone, one that's focused on productivity and how that's disinflationary, in which case they can probably still get cuts done this year, perhaps later in the year. We're officially calling for 2 cuts this year. That might be a little hard to get done. Maybe it's more like 1 and they do it in December. But we still think eventually the conditions will warrant them to be able to further reduce interest rates, probably by only about 2 more cuts this cycle.
Cool. Well, let's hope that plays out. I'm sure that the markets will would appreciate that that outcome. Steph, thanks so much for joining us today, giving your thoughts on everything from Iran to AI to private credit. Folks, I hope you enjoyed that. If you did, consider subscribing to the Upside Capture podcast, wherever you get your podcasts. If you thought the points today were insightful, go to wolferesearch.com and request a trial there, and Stephanie and the team will, I'm sure, be in touch with their broad insights on macro and investing. While you're at it, head over to AlphaCore.com as well. Remember, markets may change, but investment principles endure. Until next time, look on the upside.
All graphs contained herein are shown for illustrative purposes only. There is no guarantee that any investment strategy will achieve its objectives, generate profits, or avoid losses. Past performance is not indicative of future results. Any issues or as mentioned are examples only and are not investment advice. Index returns may be referenced, although you cannot directly invest in an index. This podcast is being provided for informational purposes only and does not constitute an offer or solicitation and should not be considered tax, legal, or accounting advice. The information represents the current views and opinions of speakers as of the date of this podcast, and there is no guarantee that any opinions will prove to be accurate or any forecast made will come to pass. No obligation is undertaken to update any information, data, or material contained herein. This communication is not recommending the purchase, sale, or hold of any security. This presentation and the information contained herein may not be reproduced, in whole or in part, in any format, without AlphaCore's express prior written consent. Certain information contained herein has been obtained from published and non-published sources prepared by third parties. While such information is believed to be reliable, AlphaCore does not assume any responsibility for the accuracy or completeness of the information, which is based on matters as they exist as of the date of this podcast and not as of any future date. Before embarking on any investment program, you should carefully consider the risks and the suitability of a strategy based on your own investment objectives and financial position.